In this video, we're going to provide extensive explanation regarding our report on Shell Oil Company. This video will be covering 4 major points. The first point is international flow of funds. This point describing how Shell adapting to changes in flow of funds. The second point is foreign exchange exposure. By analyzing the strategies used by Shell to mitigate the currency exposure risk, since they have a lot of MNCs. The third point is exchange rate determinant by illustrating the currency exchange trend for the major currency used by Shell Oil Company. The last point is financing international trade, displaying the payment method used in financing Shell import activities.
Next, we go to company background of Shell. The merger between the Shell Transport and Trading Company and the Royal Dutch Petroleum Company established Shell, and the company was founded in 1907. This merger became the cornerstone of what will develop into one of the largest multinationals in the world in the oil and gas sector, and its globalization started at the beginning of the 20th century when the company started penetrating new regions. By the 1970s, Shell shifted again as they incorporated more natural gas into their portfolio and made move towards the petrochemical industry. Talking about the 2000, it was the decade where Shell began investing much more into the generating sector of wind and solar, while also biofuel, due addressing global issues with the environment. Shell has expressed an increased focus on sustainability in the 2010 and beyond, with ambitious carbon neutrality goals that will see a robust investment in low carbon technologies. Shell is currently active in more than 70 countries across the globe and has investment in chemical, aviation, and also renewable energy. Shell currently operates in more than 70 countries, which include Nigeria, China, and Netherlands, and has a strong niche in the US. Moreover, Shell has diversified into renewable sources of energy, which include solar, biofuel, wind energy, and even hydrogen technologies, in addition to venturing into electric vehicle charging infrastructure. With the subsidiaries like Shell Energy and Shell Chemicals, the company has boosted its competitiveness in the aviation service market, as well as the provision of industrial chemical and clean energy. With an increasing focus on sustainability, Shell is actively planning for a low-carbon energy future while maintaining its leadership in global energy markets.
For this part, we will analyze how the disruption of flow of funds will affect the operation of Shell MNCs over the world. The Shell MNC's operation may affect by few factors such as the national income of the partner country, the inflation rate, and the exchange rate of a country. The first point is national income. Let's take a look at the chart. This chart displays the level of national income of a few Shell MNCs countries, including USA, Canada, and Malaysia, since 2019 until 2023. As we can see in 2019, these three countries' national income slightly dropping from its previous year. This is because of unforeseen events that happened, such as COVID-19. So how does this situation affect Shell Oil Company? When a partner country national income is decreasing, the MNC in the country will also reduce the consumer spending, that will affecting the sales and revenue of the Shell MNCs. It will also increase the labor costs and raw material. When the national income is low, some countries may take an initiative by increasing the taxes to compensate the deficit of the income, which will also affect the financial planning of Shell MNCs. At 2021, the national income of these three countries has increased until 2022. This will affect the performance of the Shell MNCs in the country by able to acquire better quality of resources and reducing the production of costs for the MNCs. The high consumer spending level in the high national income country will provide greater sales and profitability in the market. The second point is inflation rate. The inflation of a country definitely affects the shell MNCs. Based on the chart, the inflation rate was high for three countries during 2022. The high inflation rate will cause the cost of goods and services in that country increases. This can lead to higher costs for shell when importing raw materials, equipment, and all other supplies from that country. The increased cost of production will also cause the disruption of the supply chain. Higher inflation can disrupt supply chain by increasing the cost of intermediate goods and services, leading to delays and inefficiencies. When a trade partner country inflation rate is low, the cost of import for shell will also become lower. Hence, it will increase the amount of import and export transactions for shell. The third point is exchange rate. The exchange rate of a country has become a major role in deciding the financial strategies that will be applied to the MNCs. According to the table shown, when the cost of exchanging GBP to one foreign currency is increasing, it implies that the home currency is weakening. That will lead to the value of revenue gained from the MNC is decreasing. It will also impact the profit margin because the cost of export or import the goods for shell will also increase. When the cost of exchanging GBP to other foreign currency is decreasing, it's signaling that the home currency is becoming stronger. This will lead to decreasing the cost of input for shell that are sourced from different countries. It will also increase the amount of goods available for the market. So the next part is foreign exchange exposure. Shell manage currency exposure by employing various hedging strategies to mitigate the risk associated with the exchange rate fluctuation. This includes using financial instruments such as forward contracts, options, and swaps. These instruments help lock in exchange rate for the future transaction, reducing uncertainty and potential adverse impacts of currency movement. As for the transaction and translation exposure, shall face transaction exposure when engaging in international transactions denominated in foreign currencies. To manage this, shall use forward contracts and other hedging instruments to lock in exchange rates for specific transactions. This ensures that the cost or revenue associated with this transaction remains stable regardless of exchange rate fluctuation. As for the translation exposure arises when Shell's financial statements are consolidated and reported in a single currency, especially in USA. Exchange rate fluctuation can impact the reported value of foreign assets, liabilities, revenues, and expenses. Shell mitigate translation exposure by using currency swaps and other hedging techniques to stabilize the report financial result. Additionally, Shell diversify its operation across multiple currencies to reduce the overall impact of any single currency's fluctuation. The hedging strategies that Shell employs is a range of strategies to manage its foreign exchange risk. The first one is forward contract. Forward contract is agreement to buy or sell specific amount of foreign currencies at the predetermined rate on a future date. The second one is option. Financial derivative that provide the right but not the obligation to exchange currency at a specific rate. The third one is swap. Agreement to exchange currency cash flow between different currencies. By implementing these hedging strategies, Shell can effectively manage both transaction and translation exposure, ensuring financial stability and minimizing the impact of adverse currency movement.
Next, let's discuss about exchange rate determination. Shell business operations are fully globalized and advance greatly with this major currency, which is United States dollars, euro, and Chinese yuan. First, exchange rate trend USD GBP 2024. As we can see, in January to April, the USD GBP exchange rate depicts a growing pattern, indicating that the USD is getting stronger when compared with the GBP. This is probably was the case by the strong US economic result and by the fact the Federal Reserve is still hawkish on the interest rates. At this period of time, the US managed to achieve strong result in the labor market and contains lower inflation, which in turn increased the dollar's attractiveness. In turn, the Bank of England was blamed for being too hesitant to tighten policy appropriately to inflation in the UK. Next, the period from April to August saw the USD depreciation against the GBP. This devaluation of the USD can be placed during the time the economy of the US slowed down and confidence in the UK's ability to handle inflation increased. The Federal Reserve announced a likely pause on interest rate increases for June 2024 owing to the threat of uncontrolled economic growth. This significantly affected the USD again. In contrast, the Bank of England increased the interest rate, which resulted in a stronger GBP. August to October, the exchange rate fell more as the USD continued to decline against the GBP and didn't change until October. The market began to change its perception of the USD, which marked the beginning of a sudden reversal. The USD dropped because the inflation data in the US for September was weaker than expected, which in turn led to lower forecasts about further rate increase. And lastly, October to December, the USD-GBP exchange rate grew almost constantly through this time, indicating growth in US confidence as the GBP one seemed to be deteriorating. The UK have experienced both political and economic issues, which in turn decreased confidence in the GBP. Meanwhile, the US ensured to retain a hawkish stance, placing importance on maintaining high rates for extended periods of time. Next, exchange rate trend EUR-GBP 2024. In the first quarter of 2024, there was a noticeable dip in the EUR-GBP currency pair, which can be interpreted as the euro depreciating against the British pound. There are many reasons for this. It could be attributed to the increased confidence in the UK economy, the Eurozone economic indicators being considerably weaker, or individual business investor metric. If Shell had a considerable set of operations in the Eurozone or the UK, the decline of the euro will have resulted in lower earnings in UK pounds. This way most likely the case as euro index earnings are likely to lead to a depreciation in shares revenue. Next, the euro gained momentum in the second quarter of 2024 and helps stabilize euro-pound ratio with some slight fluctuation in May and June. Share central's policies, ongoing geopolitical tensions, or the dynamic nature of the global energy market might have been some factor responsible for this volatility. This mix, along with the euro-pound mix, will have added additional unpredictability for shares foreign currency interaction, greatly increasing the complexity of the intra-compartment transactions. In August to December, relative to the pound, the euro declined drastically throughout the year and further between the latter month of 2024 and November, during which the euro reached its lowest point. For Shell, the enhancement of the euro at the year end might have eased up euro-based earnings, especially if the company incurred additional costs in pound during the start of the year. Lastly, the exchange rate CNY-GBP 2024. In January to March, the exchange rate appeared to have dipped a little over time, and the yuan seemed to have weakened against the pound ever so slightly. For Shell, the implication of this will be a reduced cost for imports priced in yuan. However, it will mean reduced demand from the Chinese market, impacting revenue. In April to June, with the pound becoming stronger against the yuan, this pace in time for Shell will have resulted in lower operational costs, through import from China. However, when converted into pounds, the earnings in Shell's case may have been devalued. In July to August, in this quarter, Shell seems to be buoyed as the yuan's appreciation indicated improving economic condition in China. Increased foreign demand for Chinese goods, coupled with favorable policies, could have fueled these demands. In September to October, the graph depicts the recent worsening of the yuan against the pound, affecting Shell negatively. In this space, Shell might have suffered due to decreased demand for energy-related export to the region versus lower import costs from China. Lastly, in November to December, the yuan witnessed an impressive recovery and was able to appreciate against the pound continuously. For Shell, a stronger yuan would have meant paying a higher price for Chinese import. However, it may also signify an increased energy demand from China, which will remain favorable for Shell. The impact of currency changes on Shell performance. The first one is strengthening USD boosted crude oil revenue. The appreciation of the USD during critical times made it easier to carry out crude oil transactions, but increased expenses in GBP and EUR, slightly reducing profitability. Second, euro volatility complicated operations. The swing in range of euro throughout the year made things a bit tricky while managing the European business of Shell. The periods when the euro was strong piled on to the operational costs, meaning that the profit will have a exposed downside risk, and a stronger euro brought revenue to the table but at the cost of GBP. Lastly, yuan fluctuation affected cost and demand. A weak currency in yuan aided in operational expenditure as it reduced import costs, but it also highlighted problems in the underlying economy of China, which in the short term has dampened the growth for energy consumption demand. In contrast, a stronger yuan had come at a later stage in the year, which indicates that the economy will improve, and with that, the demand will be higher.
So I will continue to the next part, which is the financing international trade. So Shell, one of the most large MNC that employ a variety method of payment for importing goods, which can be balanced the cost, risk and efficiency. There are three types of method that used by Shell MNC for importing goods, which is the first one is letter of credit, open account and cash in advance. So I will explain the first part, which is the letter of credit. There should be a security for the buyers as well as the seller to make sure that Shell supplier, including exporters of crude oil or manufacturers, deliver on their end of the bargain in order to be paid. So this method can reduce the risk of suppliers and improve the negotiation with payment terms. For the example of Shell's context, LC letter of credit could have been used where Shell imports massive quantities of crude oil or refinery equipment, or where Shell is dealing with less known suppliers. So for the second method is open account, where it's been made after the delivery of goods or services have been offered. This method of payment and delivery of goods within agreed period to improve cash flow. Shell only using this method with supplier that they know are reliable, or Shell's key supplier with whom they have long-term contract. So for example, in Shell's context is seen in the current method, companies need to have high trust with the counter partner transaction with the known global partner. For example, petrochemical suppliers might use such a method. And the last method is cash in advance. It means that they paid for in cash before the shipment. So Shell use this method where the supplier is located in high risk country, or where there are regulation to it. For example, I guess it is quite possible, but rather than exception when it comes to small scale order of special equipment of materials. So for the next part, the Shell Sedia Berhad is likely to use a variety of trade financial tools which help manage its financial obligation while maintaining operational efficiency. So the first one is banker acceptance, one of the most common and short-term credit formation tools in the field of trade finance. It is an exclusive instrument through which a bank undertakes to pay a specific sum of money and at a future and fixed date, often employed in international business. Banker acceptance are usually employed to protect payment for exporter and afford the importer a certain period with which to effect the payment. In example, facility for which Shell give cash when it acquire crude oil or equipment from supplier while agreeing to pay the money later. This method enables Shell to retain cash flow for running the business. For the second point is forfeiting, the industry that involves the selling of accounts receivable to a third party with a view of helping exporter manage their risk of exporting and cash flow position. For example, Shell, when importing large piece of equipment or undertaking huge infrastructure project, the firm might employ forfeiting in order to get the financial risk involved. As suggested, this is especially helpful when working with importer located in the immigrant countries that might pose higher credit risk. So the third one is trade receivable financing, where this is the financing tool that help management to increase the amount of cash which is available for its use by selling its trade receivable. It's green fund necessary for working capital without waiting the payment of invoices from customer. So for example, Shell transaction with its counterparts on the global market as an upstream and downstream global oil and gas company with additional offering of renewable energy products. And the last one is counter trade, the counter trade is a big trade structure where the product or services are sold without using money. It is particularly factual in international trade where the credit controls like restriction in currency front of scanty foreign exchange. So for example, Shell undertakes its business in a country that has a serious problem of oil shortage or foreign exchange, while at the same time this same country has a plenty of agriculture produce. So Shell willing to provide Africa crude oil and take agriculture product it need to sell in different market. So example of application in Shell annual report. Although Shell Corporation annual report do not give a clear picture on how it use counter trade or receivable financing, it is possible to pick hints from the financial statement. For instance, Shell speaks of such reality-enhancing financial instrument as derivation and debt instrument which help manage cash flow and risk. Suggestions related to trade payables managing imply the utilization of approaches such as letter of credit or supply chain financing. For conclusion, our group project have focused on the arrangement for the international financial management of the company referred as Shell. It emphasized on the strong relationship between global economic factors, national income, inflation and exchange rate, and Shell operation. Currency risk management is underlined as a critical approach in the study and different approach used by Shell to address the risk and analyze. So this report also looks at the sources of financing for international trade with Shell, the various method of payment used being letter of credit, open accounts, and cash before shipment. They show that payment method selection should consider cost, risk, and efficiency factor in equal proportion. Last of all the case study also attempts to explain how fluctuations in currency affected businesses operation of Shell. It demonstrated some of the difficulty that result from fluctuating currency rates and the necessity for dealing competently with them. Another interesting suggestion made by the authors of the report is that the fact that Shell need to incorporate with operational strategies for the new economic structure existing in the global world. That's all from our groups. Thank you.